Thank you for still being here. We are going to be coming into the second panel. The second panel is going to deal mostly with listed private equity, which is a new asset class, which is very interesting because it's something that we want to start promoting and implementing in Greece. And the same structure, the keynote speaker, Michel Degosiou, is founder and managing director of LPQ, which is a company that initiated the data aggregation and index provision for listed private equities. And he's going to give us lots of information about the listed private equity market and a little bit about listed infrastructure projects. So, Michel.
Yeah, thank you very much, Nikos. It's really a pleasure to be here. And I'm convinced that you have a very good timing in having this event today, because when we talk to investors, we realize that investors really have a problem in their asset allocation. For example, when you look at German government bonds, 80%, so 80% of government bonds in Germany have a negative yield. So the question is, who is buying such type of assets? And many investors are now looking for alternative assets. They are looking for private equity investments, because private equity is one of the few asset classes right now where you can expect a return based on fundamental factors and not only based on the fact that central banks are printing money. So you really get a fundamental return on private equity. But before I come to that, just a few words on LPX. LPX was founded in 2004, so more than 12 years ago. And we had been the first ones analyzing listed private equity companies and packaging listed private equity companies into an index, and then having an ETF, having an index fund or certificates linked to this index. And by this you have a daily liquidity of private equity. And this opens the door to a new group of investors that usually need a liquid investment and are not able or don't want to invest into a closed-end private equity fund where you're usually locked in for 10, 12 years. So this is a liquid alternative to invest into private equity and to invest into infrastructure. You have here an overview of our indices. We have global indices, we have regional indices, we have style indices. So for example, the LPX buyout only includes companies that provide buyout capital. The LPX venture only includes companies that provide venture capital investments like seed money capital or like early stage capital. Mezzanine means companies that provide debt structures in the form of mezzanine capital. So we really track, I would say, the whole private equity asset class. For each index, we have 3 types of indices. The first one, LPX Equity Index Series, is based on the stock price of the private equity company. And this is then used for ETFs, for index-linked products, for certificates, for swaps based on the index. The second type of indices are so-called NAV indices. These indices measure the fundamental value, the net asset value, or the book value of a private equity company. And the third one compares both, compares the market price and the NAV price, and then you either have a premium or a discount, but I come to that later in the presentation. Introduction to listed private equity. Usually when you think about private equity, you think about a closed-end private equity fund where you're locked in for 10 or 12 years. Those so-called primaries or closed-end private equity funds are also traded on the secondary market, but also in this case you usually have lock-up periods of up to 4 years because of the transaction costs. It simply doesn't make sense to trade them on a regular basis. In case of listed private equity, you don't have a lock-up. You can buy a private equity company over the stock exchange any day you want, so you don't have any lock-up, and you have an immediate exposure to private equity. And maybe another point, we don't have to go through all points regarding the diversification. when you have a listed private equity company, usually they invested into 10, 20 or 30 companies. When you buy 10 of those companies, you have a diversification of several hundred companies. Whereas in the case of closed-end private equity fund, it's very difficult or time-consuming and costly to get a very diversified portfolio of investments. To give you some examples of listed private equity companies, in general, we differentiate three groups of companies. The first one are direct investing companies. Those are companies that make investments from their own balance sheet, that have their own management team, prepare the IPO, sell the company. So basically what you expect from a traditional private equity company. Example is Rathos, that is listed in Sweden. Deutsche Beteiligungs AG is listed in Germany. Eurazeo is listed in France. And interestingly, usually you don't know that type of companies. But for example, Eurazeo was the owner of Europcar, and they brought Europcar to the stock exchange last year. So it's interesting to see, which type of companies sometimes own companies that you use on a daily basis, which everybody knows. The second group are so-called private equity fund of funds. Those are companies that invest into closed-end private equity funds and are listed on the stock exchange. Spears is listed in Copenhagen, and they make investments into private equity funds. They make around 10% of the total listed private equity market. And then the third group are private equity fund managers, which manage closed-end private equity funds and get management fees from managing those funds. So those are the three types of companies we are analyzing and which are part of the indices and of our research. Summarizing how those companies work, how those companies are structured. On the left-hand side, you see stock, which means you buy the stock on the stock exchange as an investor. You buy basically the balance sheet of those companies where the investments are lying on this balance sheet. The management of this company can either be internally managed or externally managed. And in some cases, you have also an additional fund management business. So it's just summarizing how direct investing listed private equity companies are structured. Of course, it makes a difference whether you have an internal management team or whether you have an external management team regarding the costs, regarding the valuations, or whether you have an additional fund management business. But in general, just summarizing how those type of companies work. To give you another example, that is Onyx. Onyx is listed on the Toronto Stock Exchange in Canada. And Onyx does both. They are listed on the stock exchange. They make investments into unquoted companies, private equity investments. And on the other side, they are managing private equity funds where they are generating fee income from managing those funds. And interestingly, the management fees they are getting from managing those funds is higher than the cost they have for running or for managing the funds that Onyx has on the balance sheet. So basically you get the management of the companies for free because the management fees are higher than the cost they have for their employees and so on to run that company. So that's a very interesting company. I like that company very much, to be honest. They do a really great job for decades now, and is one of the best examples in this area. To give you other good examples, HG Capital Trust listed on the London Stock Exchange, or Graphite Enterprise Trust also listed on the LSE. And what you see here is not the stock price. You see the book value, the net asset value of those companies, which shows you the historical fundamental performance of those companies, excluding the influence of the stock market. And this is basically what is measuring the fundamental performance of that type of companies. And this goes back to the 80s, and you see the dot-com bubble, you see the financial crisis. But interestingly, those companies were able to invest during the crisis. They had cash in the crisis, and after the crisis, they made a great deal with those investments they made in that difficult times. And I think this is another reason why I'm convinced that it's a very good timing to have this event today, because you really should look at those companies when you have difficult times, because that are usually those times where you can expect the highest return in the future. So that type of companies are included in our indices. Just to give you one example of the index, globally there are around 300 companies, but to be honest, there are a lot of very tiny ones, a lot of illiquid ones. So we do research on around 120 listed private equity companies, where we look at the balance sheets, where we look where do they invest in, how much leverage do they use when they make investments, and what type of industry areas do they invest in, and so on. So a lot of data we are covering on those type of companies. And once we have done this research, we do a liquidity analysis. So we look at the liquidity on the stock exchange. We look at the bid-ask spread. We look at the trading volume, at the relative trading volume compared to the market cap, and so on. So a lot of liquidity analysis we do there. And then for the LPX 50, for example, we take the 50 largest companies out from the liquidity analysis. And to give you some performance figures, this is back to 98. You see the dot-com bubble in 2000, 2001. You see the last financial crisis. And currently the question is, where are we now? Are we again in a situation where we have a bubble? Are we again into a situation where we have very high valuations? But I will show you some arguments later on why I'm convinced this is not the case today. This is the performance since the financial crisis in 2008 compared to the MSCI World, which translates into a return per annum. So that's an annualized return of around 21% for LPX 50 and around 15.8% for the MSCI World. And the question now is, are we again in a situation where we have a bubble or not? To start this, I would like to show you not only the LPX 50 based on the stock price performance, but also on the book value performance. So in blue, you see the blue line shows you the fundamental book value performance of listed private equity companies. And this is something you can compare to the valuation of a traditional closed-end private equity fund. And the red line shows you the stock market, the stock price performance of those type of companies. And not surprisingly, the stock price is overshooting in the one direction or in the other direction. But when you take the blue line and when you compare the blue line, the net asset value, the book value performance, to the performance of closed-end private equity funds, you come up to a correlation of more than 0.9. So there is a very high correlation using the book value performance compared to traditional closed-end private equity funds. But of course, the red line, the stock market performance, shows you in addition to that the influence of the stock market performance or the market performance in general. Some characteristics of the index. Left-hand side shows you the industry groups. Industrial, consumer, discretionary, is nearly 50% of the index. But it's I would say a diversified basket of private equity investments, diversified over different industry groups, also diversified over vintage years, in which I think could be compared to a diversified closed-end private equity portfolio. So the question now is, and we are asked this question very often, why should you invest into private equity now? Why should you invest into listed private equity now? Are we again in a situation compared to 2006 or 2007? And there are a lot of reasons why this could be the case. I will shortly show you why I'm convinced this is not the case. I have brought here some historical performance drivers. Just to give you some background how we analyze this market. So 2008, 2009, we had a very high degree of leverage. And this was also the main reason why many listed private equity companies, also why many private equity funds got into trouble. There was a refinancing risk. I remember that everybody feared, well, in 2012, 2013, 2014, we will not be able to refinance our bonds anymore. And when we look at the current situation, it's cheaper than any time before. 2009 and 10, the main performance drivers were quantitative easing, central banks lowering the interest rates. But currently, since 2013, the main performance drivers in this market are really fundamental factors. Is the fact that private equity companies help the companies to grow their investment, help the companies to grow their EBITDA multiple revenues, help to perform an IPO, prepare the exit, and so on. So really fundamental factors which is driving the performance since 2013. This was the case last year, and I'm expecting this will be similar this year. And when we look at the dividend yields last year, on average in this sector, we had more than 6% dividends paid out from those companies. And this is only possible when you have successful exits, when you have successful IPOs in this market. So, but now I will show you 3 reasons why I'm convinced we are not in a bubble like 2006 or 2007. This shows you the aggregate capital raised on a global basis for total private equity. So in blue one, you have in billion US dollar the capital raised, and the red one, the red line shows it in the capital distributed in billion US dollar. And you will realize in 2008 you had nearly 700 billion capital raised for private equity investments, and only roughly 150 million paid back from capital distributed. So there was a very high demand for private equity, and this was the case in 2006, this was the case in 2007. And currently we have a different picture. We have very good exits, we have IPOs, and capital is redistributed to the investors. So the red line shows you in 2014 nearly 800 billion paid back to the investors on total private equity. On the other side, only around 550 billion invested into the asset class. So the money flowing into private equity is lower than what is paying back to the investors. And this was it was a completely different picture in 2006 and 2007. At that time, you had more money flowing into the asset class than was paid back to investors. So basically at that time, demand was driving the prices, and only the demand was driving, not the fundamental factors anymore. So everybody could raise a private equity fund and raise some money. That was a very easy task. Currently, that's not that easy anymore. So investors are really looking only for the good private equity funds. And the second reason, this somehow corresponds to that slide. When you look at the valuation of the buyout transactions in billion US dollars, again for the total private equity market, 2006 and 2007 you had more than 600 billion in buyout transactions, and currently around 250 billion. This also shows that the market is, we have an, I would say, a healthy private equity market, and the prices are not driven by high leverage, are not driven by high demand for this asset class. It's really, I would say, a healthy, a stable environment for private equity. And then the third reason, this comes back to our indices. As I said at the beginning, we are comparing the fundamental valuations and the market price valuations. And then when you compare both valuations, you have either a discount or a premium. So a discount means that the stock price is lower than the book value. A premium means that stock price is higher than the book value. And until 2007, we had premiums in the market on average. Then 2008 and 2009, we had high discounts of up to 70%. And currently, we are at a discount level of around 30% on average, which means you have companies that have a discount of 40 to 50% and other companies that have a slightly a premium of around 5 to 10%. So it's really a heterogeneous market, but it's not in a situation that we had in 2006 or 2007. It's a completely different picture right now. Then the question is, how can those companies manage the discount? Because usually you don't, like you don't want to see a discount, usually you would like to see a premium. So many investors are asking that question to the management companies: how do you manage the discount? How do you close the discount? And basically there are 3 options to close the discount. One option is paying a regular dividend. And this means every year. Even in 2009 or 2008, you would have to pay a dividend. For example, GIMV, that's a Belgian listed private equity company, has that kind of dividend policy. They are paying a dividend every year. Even in 2009, even in 2008, they paid a dividend. And they have a lot of institutional investors like endowments or like pension funds, because pension funds are by definition, they need a yearly dividend yield. Otherwise, they would never invest. And that company is always trading at a slight premium because of the dividend policy. Then you can pay special dividends, for example, when you have a capital gain of an investment, and we know companies that have in their policies written down that they have to pay a dividend in case they have a capital gain of a single investment. Then the other one are share buybacks, and there are basically 2 options there. You can either buy your shares on the stock exchange, or you can buy shares at a premium. So basically you say, well, I'm convinced that the stock price of my company is too low, so I'm willing to pay a premium of 10 or 15% over the stock market price in order to attract other investors to buy my stock. And then the question is, what is the best way to manage the discount? When we look at the companies that we analyze, based from these 3 options, paying a regular dividend every year, even in case there is a loss in that year. So in that case, you would have to pay the dividend from your reserves. This has the highest effect on the discount. That's the best way to lower the discount. Special dividends, based on every capital gain, is then the second best, I would say. And the third best are share buybacks paid at a premium at the market price. And all of those measures you will see, there are different policies, different companies, everyone chooses another policy, another option, but you will find all of that options in the market. And the question always is, what can we do to lower our discount? And I always say, well, pay a regular dividend, install a dividend policy, because then you can attract pension funds, then you can attract endowments that need a regular dividend every year. So, last 2 slides. What kind of benefits do we see for investors? Summarizing what I have said, you can invest at a discount, of course only in case you are convinced that the discount is not justified. There might be companies where discount is justified, for example companies that use a very high degree of leverage and then run into a crisis like 2008, then in this case discount is justified. You really have to look also on the leverage structure, on the debt to equity structure of the investment company. But on the other side, you have an immediate access to private equity, so you don't have to wait for several years to build up your exposure to private equity. You have an immediate access. From day one, you are invested into private equity, or you are exposed to private equity. You have a very high diversification. By just buying 10 or 15 type of those stocks, you have a highly diversified private equity portfolio. And then on the other side, when we look at the current valuations, we still see a lot of return potential for the next coming years. Yeah, that's basically, in short, what I would like to say. Just maybe one word on listed infrastructure. Beside listed private equity companies, we also analyze listed infrastructure companies, and by infrastructure we mean basic infrastructure, so grid networks, pipelines, airports, toll roads, water pipelines, and so on. So only basic infrastructure where you really get the investment returns or the return characteristics you expect from an infrastructure investment. And we exclude all the related services. For example, a power producing company is not an infrastructure company. only that company that provides the grid lines is for us an infrastructure company. And when we apply our definition, you see here infrastructure companies classified by major data providers. So when you go on Bloomberg or when you go on other data providers, you will find around 2,000 companies classified as infrastructure companies. And when we apply our filter, only 181 companies fulfill our criteria for an infrastructure company. So infrastructure is it's a buzzword. Everyone has another or different definition of infrastructure. We have a very strict definition of that, of infrastructure, and really look at the revenue streams, really analyze where does the revenues come from. Do they come from providing infrastructure, or do they come from producing power or using an infrastructure? That makes a big difference. So that's all from my side. So now I give over to Nikos. Thank you very much.